Happy holidays. I'm John Kosar, Chief Market Strategist at Asbury Research. Thanks for viewing our latest Following the Money podcast. Today is December 6th, 2023. We are a couple of days off of our normal 2-week schedule for this free podcast, but we are pleased to introduce a new video version of it. We are considering making this video version a permanent change. So if you like this version better than the previous versions that were audio only, please click the like button to let us know. Today, I'll be talking about what our latest analysis and data-driven models are saying about current financial market conditions. That is, when to be on offense and looking for opportunities, and when to be on defense and protecting your capital. A little bit more than 2 weeks ago, our October 18th Follow the Money podcast was entitled Positive Asbury 6 equals favorable conditions for more market strength. Since then, the benchmark S&P 500 has risen by an additional 2% to trade as high as 4,600, and it's actually risen by 10%. The S&P 500, that is, has risen by 10% since the Asbury 6 first went to positive on November the 2nd. We also pointed out on November the 18th that our SEAF model, SEAF is an acronym for Sector ETF Asset Flows. Our SEAF model had still maintained its October 9th long/overweight bias on the technology sector, which we use the XLK as the ETF to trade that. Since October the 9th, XLK has risen by 9% while outperforming the S&P 500 by 4%. Now let's follow the money. In this new video version, I'm going to take you inside Asbury Research's Research Center to show you some of the key models and metrics that we are the most focused on right now. So here we are. This is the landing page at asburyresearch.com. So we're clicking on the Research Center button for subscribers only, but you get a chance to see what it looks like. Our Asbury 6 model, which is right here. Our Asbury 6 model is updated every day about 2 hours after the close, and it uses a diverse group of 6 different metrics to try to determine the internal health of the market, the real health of the market, kind of like what happens when you go to the doctor's office for your annual visit. The doctor looks at you coming through the door, and he makes maybe a visual guess on what your health might be, and then he sits you on the bench. He starts checking your pulse, checking your blood pressure, listening to your heart and lungs, doing your reflexes. Then he gets a lot more accurate kind of indication of how healthy you are. This is what the Asbury 6 does for the stock market, and we built it because the markets have changed over the past 10 years. They're much more volatile day to day. The markets can be down hard, or the S&P 500 could be down 50 one day, down 30 the next, scare you out of your long idea or your bullish implications that you had thought, and then 3 days later it's setting fresh highs, forces you to get back in. The Asbury 6 helps us to not to chase the tail of the market, so to speak, and to get a much more accurate under the hood indication of what the strength of the market is. So you can see right here, we'll blow this up to make it bigger, of the 6, the only one of the 6 Asbury 6 constituent metrics that is negative is the rate of change in the S&P 500. That just went to negative on the close yesterday. All of these others are all green. I can tell you that a couple of these are close to turning negative. What does that mean? It means that the market really needs to start a new leg higher from here if it's going to continue its current uptrend that started in October. If we start seeing the Asbury 6 start to fail here, another 1 or 2 or 3 turn red, that's going to be an indication to us that we are going into some kind of a corrective period in the market. So if you'd like to learn more about the Asbury 6, all you need to do is go to asburyresearch.com. You could go here across the top. You can go to models and scroll down until you see the Asbury 6. The next one we're going to look at on the video today is our SEAF model. I had mentioned it earlier, Sector ETF Asset Flows model. Here it is, updated through the end of last week. This model is different in that rather than following the relative performance It's following the money moving around the 11 sectors of the the sector spiders of the S&P 500. I built this model, I don't know, 6 or 7 years ago, and it has done very well by staying in the places where the money is going, avoiding the places where the money's coming from. Here, just for example here, we do this in 3 different time periods: trading, tactical, and strategic. And the biggest or the best acceleration of assets in all have the lowest scores. So last week, the best acceleration of assets in were in number 1, financials, and number 2, in utilities. The most acceleration in assets out were number 10 in energy here, XLE, and healthcare, which is number 11. So what we do is we add these scores up, and the top scores, which are from 3 to 15, those are favored. And then we have from 16 to 24 is neutral, and the avoids are from 25 to 33. Healthcare is in the avoid category, and we have several here. So the top 3, according to the model, are technology, which I had already mentioned that we have been overweight, or the model, I should say, has been overweight technology since October. It's already picked up 4% of outperformance versus SPY and is up 10%. Financials and real estate are newer choices by the model, or newer positive rankings by the model. As we said before, if you'd like to learn more about this model, you go across to the top. You will start here on our landing page, and you go across the models, and you find SEAF and scroll down. There's more information and charts about that there. Next, let's look at some charts from our monthly investment compass. Our monthly investment compass is, as the name suggests, it's a monthly report. It comes with an accompanying video, and we look at about 40 different charts, our own models, various data series to try to get more of a strategic, comprehensive look at what is happening, or I should say the most important indicators to pay attention to. So here's the cover of that of that particular PDF that comes with it. And we're just going to jump around to a few pages that I thought might be particularly interesting. The first one has to do with pricing. So we have the SOX index testing important resistance at 3875. The SOX is the semiconductors, Philips Semiconductor Index. It typically leads the market both higher and lower up against resistance. Here, we've got the NASDAQ Composite Index. The NDX, the NASDAQ 100, is the large cap NASDAQ index. The comp, or the comp Q here, is the broader index. There are more constituents in there. Note that it's testing some really important overhead resistance here at 14,447 to 14,647, which is the July highs from this year and the March of 2022 high. So you've got 2 market leading indexes that are bumping up against some really formidable resistance. What does that tell us? It tells us that the market, if it can't get through these, and we start to get a correction because these are market leaders, we're more likely to see the first indications of a correction from these 2 indexes. Let's move to another one. This is the S&P 500. Here we have the S&P 500 also testing some really important resistance from 4607 to 4637. That is the high from back in July of this year, and it's the March of 2022 high, up at 4637. Again, formidable area. These areas generally, these kind of strong areas are generally not broken on the first try. So we're really watching with a lot of interest to see how it does here. The initial support level is down at 45.41. If we break through there, that would be an indication to me, as well as if the Asbury 6 starts to turn red. We start to get more and more red constituents from the Asbury 6 that we're going into a correction. So if you were a subscriber, you should be watching the Asbury 6 every day for as early an indication as you can get as to whether we're going to have some kind of a correction here between now and the beginning of next year. This on the right is the weekly version of the S&P 500. it shows that a big chart pattern was formed around 3,600. An inverse head and shoulders pattern. It was triggered on May the 19th, or it was initiated, I should say, on May the 19th. It still targets a move to 4,800. So what does that mean? That means if we do have some kind of a corrective move downward from here, the major trend is still up. And as long as we stay up above 42.26 area, we still are in an uptrend, and some kind of a correction down here could give us a better opportunity to buy perhaps early next year. There's one more chart from this 40-page report, or 40 chart report, I should say, that I want to talk about. And that is the ETF asset flows going into the QQQ. The QQQ is the ETF that tracks the NASDAQ 100, the large cap tech index that I had mentioned just a few minutes ago. You see these assets starting to expand here. Basically, in the beginning of this year, once that happened, we got this really nice, strong rally into the July high. You see these assets went flat since then, and that took us down to the October 26th low. We tested the 200-day moving average here in orange, and now we're moving higher again. Here's what I'm watching. Those assets are testing their December 2021 high several years ago at $214 billion. Let's call it $215 billion. And we haven't moved through there by quite enough to make me feel comfortable that we're beginning a new move higher in the NDX. If these assets start rolling over the next few days, we're watching this one like a hawk too, that will be an indication that there is money starting to leave this market leading index, and that will be a very important indication to us that we are becoming more vulnerable to some kind of a downside correction. So there it is, our latest bi-weekly Following the Money podcast for today, and a short synopsis of what we think is particularly important to pay attention to as we move into the end of the year and the beginning of 2024. We'll see you right here again in about 2 weeks with our next Follow the Money podcast. Remember, if you like the video version better than the audio, which we've been doing for about the past year now, please give us a like and let us know that, because we're trying to decide which one is going to be the most popular with our viewers and with our listeners. In the meantime, you can subscribe to the Asbury Research channel on YouTube for more podcasts and data-driven trading and investment information just like this. If you would like to learn more about our Asbury Research data-driven models, again, visit Asbury Research and click the Models tab across the top of the screen. If you're interested in getting more information about our services for individual and professional investors, just visit asburyresearch.com and use the contact button right here at the end of the top of the screen to contact us. Let us know if you're a portfolio manager, if you're a financial advisor, if you're an individual investor, what you're looking for, and we'll see if we can help you. Have a great holiday season with your family, and we'll see you in a few weeks right after the first of the year with another one of these.